Hi everyone, this is Nick Curtin, Head of Business Development at Foord Asset Management in South Africa. I've got with me Brian Arcese, one of the Senior Portfolio Managers in our Singapore office on both the Foord International Fund and the Foord Global Equity Fund. We're just going to spend a bit of time talking through what we've seen to the start of this year and where we think things are going. So 2019 was one of the best calendar years in global markets in a decade. And boy, welcome to 2020. Brian, you've got some interesting stats around the recent market rout.
Yeah, hi Nick, and thank you. Absolutely. Certainly following on 19, 2020 has been incredibly volatile. It's been one of the most volatile periods in market history. The VIX, which is the Chicago Board's Option Exchange Volatility Index, which many people look at to measure volatility, started the year at less than 14 and rose to above 80. So just for context, I mean, that surpassed most of the period of the GFC, so setting new highs this year. We also saw the S&P transition the most quickly it ever has in modern history from a bull to a bear market. So that's typically measured by a 20% decline in that index. And during this kind of first quarter of 2020, that happened in 20 days. So again, for context, I mean, typically going from a bull to a bear market takes about 275 days. And this has been sort of the fastest one in history. I guess the last piece that I would add, I mean, just for kind of good measure, the S&P has also had 9% moves on 3 consecutive days during this quarter, which is also the first time that that's happened since the Great Depression. So we've set a lot of records in the first quarter of 2020 that most of us certainly hoped that we wouldn't need to set. Now, obviously, there are very few events that can cause this type of volatility in the market. And certainly they would be described mostly as unknown unknowns. And certainly at the beginning of the year, none of this was really on anyone's radar. And obviously, I mean, what has caused it, and we can chat more about it, certainly what pricked that market bubble is the virus, which we now all know as COVID-19.
Wow, pretty well timed. Some amazing stats there. I mean, maybe let's zoom out a little bit and go back to the pre-pandemic times, sort of end of last year, third, fourth quarter 2019. I mean, where was the world back then, and how are we seeing things from that time point?
Well, certainly at the end of 2019, the beginning of 2020, things looked very, very different than they do today, both from an economic standpoint and a geopolitical standpoint. Risks had significantly declined. So at the end of 19 and sort of early January, we saw the US and China pen phase 1 of their trade agreement. Now, obviously, there's a lot of negotiations to take place, and not many expect the negotiation of phase 2, phase 3 to be either easy or completed in the near term. But just the absence of that increase in trade war was enough to add probably 0.5 percentage point to both US and Chinese GDP. So certainly moving from a headwind to a tailwind. And then also in Europe, finally, you had the United Kingdom officially announced that they would be leaving the European Union after more than 1,300 days of quite relentless debate and excruciating uncertainty. So obviously there as well, there's quite a long transition period and significant negotiation that will need to take place. But at least businesses can now plan. They know what the outcome will be. So that year on year was more of a tailwind than a headwind as well. And then from a financial conditions standpoint, I mean, the US Fed had lowered rates, interest rates, 3 consecutive meetings moving into the tail end of 2019. And real wages in that US economy had really begun to increase as well, particularly at the low end, sort of 1.5% growth, all the way up to 4.5% growth. So given that economic and geopolitical backdrop at the end of 19, the probability of both a US and global recession moving into 2020 was actually incredibly low.
Right, so now, as we all know very well, in early January, the media started reporting on an emerging worrying flu outbreak in Wuhan in China. And it was interesting at the time. We had a lot of interesting conversations within the firm between Cape Town and Singapore. You guys being based over there your backyard. For us, it felt a million miles away and not that big an issue. I mean, maybe from your perspective, just tell us how things unfolded from there.
Sure. So obviously, I mean, in what really began in Wuhan and Hubei province in China in sort of November, December, really didn't begin to enter kind of mainstream conversation until early January. The first case of COVID-19 was here in Singapore on the 23rd of January. I mean, China moved what to the outside world at the time seemed relatively quickly to quarantine both Wuhan and then Hubei province. But obviously in hindsight, it wasn't quickly enough to stop the spread of the virus outside of China. I mean, today, we're obviously looking at about 1 million people that have been infected globally. The virus has spread to close to 200 countries, 50,000 have passed away already. And obviously we're now in a position where 20% or even more of the global population is really living either in some type of partial quarantine or full-scale lockdown. And even in the massive US economy, now a third of that population is in kind of full-scale lockdown, and the number of states that increase that rises on a daily basis.
Yeah, it's amazing how this thing escalated so rapidly. I don't think if you went back 6 weeks, any of us would have thought we'd be sitting unshaven in our studies talking to each other over digital platforms. But here we are. So how did the Foord International Fund and the Global Equity Fund hold up through that period? I mean, we obviously didn't forecast the global pandemic. I don't think anybody could, but were we well positioned going into this?
Yeah, well, I think it's interesting. I mean, the International Fund, both Global Equity and the International Fund are quite conservatively managed in general. We certainly weren't forecasting a pandemic by any means. But what was most interesting to me is if you look at the market's reaction as the virus sort of continued to spread, typically we think of markets as really forward-looking and discounting either future positives or future risks in sort of a real-time basis. But the market's reaction to this event in particular was really at best coincidental. And I think probably at worst it even lagged. So I don't know if that's sort of a misplaced belief in the part of the market that this COVID-19 infection would sort of remain contained in Asia and remain quite small, with the closest comparison being the SARS outbreak in 2003, or just the fact that the market struggled to discount how large and unknown this was. But all the way until kind of mid-February, the market continued to make new highs. And even in that mid-February period, you still had the infection had already spread to sort of 25 markets globally, including all large economies, all of major Western Europe, the US, China, Japan, Singapore, Korea. And so given that, and the fact that we thought the spread would certainly be larger than what was currently being discounted, we were able to hedge our positions in the portfolio. So we had begun to do that in January through a combination of shorting S&P futures and then purchasing puts on the S&P, and then significantly ramped that up in February as well. So while we wish in hindsight we had done more, we're happy with the fact that obviously the drawdown in FIT has only been about half of that, of the overall market. And then also in global equity, we've been able to outperform the index over this period as well.
Right, now for the hard question, Brian. That's the easy part done. What's the outlook from here? I mean, we're seeing a lot of commentators calling the market cheap, a lot of doomsayers on the other side of the room. Are we backing up the truck? What's going on in the portfolios now?
I think that a lot continues to remain unknown. I mean, so on the virus itself, there continues to be a lot of debate around the virulence, the fatality rate. There are significant differences in reporting across countries. So you'll see a fatality rate of 1%, for example, in country A and 10% in country B. While there are certainly differences based on the quality of care, that 1 to 10% difference is primarily a function of reporting and measurement. So ultimately, at this point, we don't quite know even how virulent or how fatal the virus itself is. And then secondarily, obviously, I mean, everyone is now quite familiar with the words quarantine, lockdown, social distancing, flattening the curve. all of which will help reduce the spread of the virus and ultimately eliminate it in the global population. But at the same time, all of those things have a significant impact on the economy. So US unemployment, for example, has gone from 3% to now over 10% in a matter of sort of 2.5 to 3 weeks. I mean, in our mind, there are opportunities that are now beginning to emerge. So I wouldn't say we're backing up the truck, but we're certainly taking advantage of those opportunities to add either to existing holdings, given that they've decreased and are now quite attractive, or to introduce new names, new quality names to the portfolio that we've been following for quite a long time. At the same time, though we've reduced some of the hedges, we continue to be quite hedged. So I think from here, because there are so many unknowns and because of our conservative nature, it's much more prudent to continue to protect the portfolio, while at the same time beginning to deploy cash in as wary a manner as possible.
Sounds like a 101 in Foord investment philosophy, Brian. Thanks to you and the rest of the team in Singapore. I think you've done a great job so far through this period, looking after investor capital. There's no pressure at all. I've got no doubt we'll be doing this again in the weeks and months ahead. To the listeners, thank you for the confidence you've shown in our ability to look after your investors' capital through these tough times. As we've always said, risk is what can happen, not what will happen. In this instance, it seems like it has. But stay invested. It's in safe hands. We've got this.
Thank you, Nick.